Hello everyone, welcome to this exercise walkthrough from our Chapter 7 exercise list for Managerial Accounting course, ACCT 428. In this particular video, we're going to look at exercise 7-5A, so let's read the question together. The question says, Carmen's Dress Delivery operates a mail order business that sells clothes designed for frequent travelers. It had sales for $400,000 in December. And because Carmen's Dress Delivery is in the mail order business, all sales are made on account. The company expects a 30% drop in sales for January. The balance in the accounts receivable account on December 31st was $60,000 and is budgeted to be $41,000 as of January 31st. So what's required here? A, determine the amount of cash Carmen's Dress Delivery expects to collect from accounts receivable during January. Now here, in this kind of question, it helps you to visualize what's going on. So the way I'm going to do this, and this is not part of the answer, it's just going to help you understand what we're trying to do. I'm just going to draw a simple timeline here. Okay. Let's say the timeline starts on December. Okay, and then January, and then the end of January. So let's call it January 31st or the beginning of February. Okay. So the company had sales of $400,000 in December, and the question already told us that this particular business only ships their orders, so all of their sales are on account. Where did we read that? Right here. All sales are made on account. Okay. So based on that, and since December sales are 400,000, so we're going to assume that the accounts receivable balance as of the end of December is $400,000. Okay. Now they are going to have some sales on January as well, but they did not really, or the question did not give us the amount of sales for January right away. It told us that it's going to drop by 30%. Okay. So we're going to use our calculators here. 400,000, this was the sales on December. If we drop that by 30%, so let's just multiply it by 70%. So 400,000 multiplied by 0.7, that will be 280,000. So these are the sales that are going to occur right here. And all of these sales are on account. So this is also the accounts receivable for January. Okay. And then we have the balance. Okay. So it says that all sales are made on account. The company expects a 30% drop in sales for January. The balance in the accounts receivable account on December 31st, meaning right here at the end of December, is going to be 60,000, right? So meaning that this amount here, most of it was collected, and the only balance that was remaining is $60,000. Okay. And then the last sentence in the data given, it says, and is budgeted to be 41,000 as of January 31st. So the balance, the ending balance for the accounts receivable account is going to be $41,000. Okay. So what part of the question we are interested in right here in order to figure out how much cash was collected? We need to look into this part right here. I'm going to say from here to here. Okay. Because even though we have the sales of the sales balance on December, which is this one, almost all of this amount was collected. We are only left with 60,000. So we're not going to worry about the difference here, which should be $340,000. This was collected already. Okay, so it's no longer going to appear on our accounts receivable balance. Okay, we only need the opening balance, which is the 60,000, how much the business have sold during January, which is the 280,000, and what was the closing balance, which is this. From these three pieces of information, we can figure out how much was actually collected, right? How do we do this? How much was actually on the balance of the accounts receivable throughout the month from the beginning balance and what was sold during January, and then we subtract. So we add these two together and then we subtract the closing balance. Okay, so if I'm going to quickly do that on my calculator, it's going to be $60,000 plus $280,000. That's $340,000 minus $41,000. Okay, and that's going to be $299,000. Okay, now just to remind you, this is not how you should solve this, but I'm just trying to help you visualize and understand what's going on. Okay, so let's go ahead and start with our answer. I'm going to say A. We're going to do similar to what we've done on the timeline here, but we're going to put it in a proper format. So we're going to say accounts receivable this is the opening balance, so this is as on January 1st. Okay, and it's this amount right here, $60,000. And then we're going to add the month of January sales. So we'll say January sales on account, which is going to be this amount, the $400,000 multiplied by 70%. And where did I get this 70% from? It's 100% minus 30%. Okay, so that's going to give me 70%. And that amount, as we have already calculated, is 280,000. All right. So adding both of these together is going to give me the amount of accounts receivable available for collection. I'm just going to call it AR available for collection. 280,000 plus 60,000, that's going to be $340,000. Okay. All we need to do now is just subtract this, the closing balance. Okay, so we're going to say less accounts receivable, as of January 31st, which is $41,000. Okay. From here we can know how much was actually collected. So we'll say cash collected or total cash collected. Is going to be 340,000 minus 41,000 and that's $299,000. Okay, and that is the answer to part A. Now let's look at part B. Part B says, is it reasonable to assume that sales will decline in January for this type of business? Why or why not? Okay, now the business is in the clothing business. Okay, so from the name we can see that this is a Carmen's dress delivery, so they basically sell dresses and things like that. And as you can notice from our timeline here, that the period that we're looking at is December to January, and then from January to the end of January, right? And the book, you need to understand that most accounting textbooks are built around or written by Americans, so it focuses on Western culture and Western holidays and things like that. And we know that in the West, they celebrate New Year's and Christmas, which occurs right here at the end of the year. So it makes sense that before Christmas season or the holiday season, many people start shopping more. They spend more on clothes and for gifts or for their own personal use and so on. So typically, Western businesses do see some increases in their sales at the end of each year. And then after the end of the year, with the new year, sales will go back down again. So it does make sense. So we can justify this prediction that the business made, that their sales are going to decrease by 30%, is justifiable. Okay, so we can say something along the lines that the sales drop or decline, let's call it decline, in January is reasonable and to be expected after, or let's say knowing that sales typically increase during the holiday season and declines after the season is over. We could also say that especially for clothing. Okay, you don't have to stick to this exact justification that I have written. You can justify it in your own words as long as you understand the business or the sector that this particular business operates in, and you understand that we are covering this particular period where we are looking at sales from the end of the year, right before the holiday season, and then after the holiday season is over. Okay, and this is my answer to exercise 7-5. I hope you found this video useful, and if you have any questions, please feel free to drop them down in the comments. Until I see you in the next exercise walkthrough. I hope you have a great day. We'll see you next time. Take care.